Hello and welcome to another TLC Tutoring Company accounting lesson. Remember, if you have not subscribed yet, please make sure to do so as we are coming up with new accounting lessons every week. Now, we are going to be going over the Perpetual LIFO method of inventory valuation. Keep in mind that this is a cost flow assumption. It does not necessarily reflect what's actually happening in real life. This is just an accounting method. So in this case, we are going to be focusing on the perpetual aspect of inventory valuation as well as the LIFO aspect of inventory valuation. Now, as a reminder, perpetual means that our inventory is updated after each and every transaction, whether it's a purchase or a sale. So these dates that we see over here are extremely important. Another thing to keep in mind is that we are going to be doing LIFO. So once there is a sale here, we are going to be considering the last ones in to be the first ones out, as in sold. So we'll get a closer look at what that means later on in the lesson. Now, I highly recommend that you use a chart like this one here, starting with your date, purchases, sales, and ending with ending inventory. That way we can update our ending inventory after each and every transaction. So let's start taking a look at the data on the right hand side here. On the first, we had beginning inventory of 60 units, which we paid $5 each for. So let's start by putting that on our chart. So January 1st, a little note that this is our beginning inventory and 60 units, which we paid $5 each for. Okay, now next let's take a look at our following date. On February 6th, we had a purchase of 100 units and we paid $6 each for those units. So under our purchases column, let's put 100 units at $6 each. And now let's update our ending inventory. Now the important thing is that we update it every time. We don't just go ahead and add what's new. We bring down what we had and then we add the additional information. So in this case, we started with 60 units at $5 each. And remember, it's very important that we stay in chronological order. So the old ones are going to go down first. That way when we do our LIFO assessment, it's going to be a lot easier to determine what's going on. And now let's add in those purchases. So now we have 60 units that we paid $5 each for and 100 units that we paid $6 each for. Okay, so on our next date, we had a sale on March 1st and we sold 90 units. Okay, now it's time to take a look at LIFO. Now, in order to figure out what we paid for those 90 units, we are going to take a look at our last ending inventory update and consider what is sold of these. Now, we sold 90 units. So the last ones in are the first ones considered sold. So how many of this layer did we sell? Well, we sold 90 of those. So essentially at the end, we're going to see that we have 60 units at 5 and then 10 units at 6 left over. So let's actually put that on our chart. We sold 90 units, which we paid $6 each for. And then in our ending inventory, we have 60 units at 5 and then 10 at 6. So as you can see, since we're using LIFO, we went to the last layer, 90 of those were sold, 10 of those remain. We didn't sell any of the next layer up, so all of those are remaining in our ending inventory. Okay, now let's take a look at our next date. On July 2nd, we have a purchase of 50 units and we paid $8 each for those. So let's put that under our purchases. And now as a reminder, we have to bring down the old and then add in the new purchases whenever we do have a purchase. So we have 60 units at $5 each, 10 units at $6 each, and then our new 50 units at $8 each. Okay, now on July 6th, we have another sale, and in this case, we sold 70 units. So let's start analyzing what's going on. Remember, whenever we have a sale, look at your last transactions ending inventory. Remember, last ones in, first ones out. So the last ones we purchased are the first ones considered sold. So we sold 70 units. So how many of this last layer are we going to grab? Well, there's 50 units sitting here in this layer. So let's go ahead and put those in. Now, does this go ahead and account for all of the units we need though? No, there's still 20 more that were sold. We need this to add up to 70. So how many more? Let's go up to the next level. There's 10 at 6. Okay, well, let's grab all of those. That'll give us 60 total units sold. Does that finish us up? Nope. We need 70, we only have 60, we still need 10 more. So let's go up to the next layer. 60 units at $5. Are we going to bring all those 60? No, just 10, because we only need 10 of those units. Okay, now when we're doing our ending inventory, let's go through each layer and let's think about what happened. How many of this first layer at $5 were sold? Only 10 of those were sold. So there are 50 remaining. Did we sell any of these? Yes, we sold all of them. And did we sell any of these? Yes, we sold all of them. So those are gone now. So we're left with 50 units at $5 each. Okay, now our next date, we have another purchase on October 9th of 30 units, which we paid $9 each for. So let's go ahead and put those under our purchases. And as always, remember with purchases, we have to bring down our old units first and then add in our new ones. Okay, now we have one more sale on December 5th, and that was for 30 units. Remember, we're using LIFO, so the last ones in are the first ones considered sold. So these 30 units actually equal the amount that we sold. So we can just put 30 units at $9, and then the 50 at $5 are still remaining. Okay, now we completed our chart, but we're not really able to answer any questions yet. Typically, what we will see for these problems is they will ask you either for your cost of goods sold or the cost of your ending inventory, or those units that are remaining on hand at the end of the year. So in order to find out our cost of goods sold, we're actually going to consider the entire sales column. So we need to determine the total cost of all of these layers. So 6 times 90, that gives us 540. 8 times 50, that's $400 for that layer. 10 times 6, that's $60 for that layer. 10 times 5, $50 for that layer, and 30 times 9, $270 for that layer. So once we add those all up, we get $1,320 as our cost of goods sold, also known as cost of merchandise sold. So as I said, the other thing that they can ask you for is your cost of ending inventory. And now instead of adding up the entire layer, your cost of ending inventory, and make sure to really remember this picture in your head of what we're highlighting here. Your cost of ending inventory is just going to look at your ending inventory as of your last date. Now keep in mind that there can be more than one layer here. If there were 2, you'd have to consider both layers for that last date. But in this case, we just have the 1. So let's just add that one up. That gives us $250 for our cost of ending inventory. So keep in mind for this problem, the more you do it, the better you're going to understand it. If you already have a good grasp on periodic LIFO, then this one shouldn't be too hard. However, you're going to want to practice this several times until it's almost second nature for you. And also keep in mind, if these little rows right here, what if this said we sold 90 units and we sold them at $100 a piece? We wouldn't care about the sales price, because the whole purpose of inventory valuation, this cost flow assumption, is on our costs, what we paid for them as a merchandising company. So continue to practice, and please be sure to let us know if there's anything in particular that you need by message or in the comment section below. Be sure to subscribe, and in the meantime, until we see you during our next video, happy studying!